How will tariffs affect restaurants? Hello, I'm Jonathan Mays, Editor-in-Chief of Restaurant Business, and welcome to The Week in Restaurants. And this week, I am joined by RB's Executive Editor, Lisa Jennings. President Trump this week announced sweeping new tariffs that are roiling global financial markets right now. These tariffs will have a major implication for the restaurant industry, and we are going to talk about that. Chick-fil-A did not have a Chick-fil-A-like year in 2024. We will try to explain what that means. Portillo's, yes, Portillo's is thinking about breakfast. Thank God for that. We will talk about that later. Joe Guszkowski talks about technology on Tech Check and a look at the CEO of 2024's most surprising restaurant chain. You're not really going to be surprised about who that is. But first, let's talk tariffs. So this week, President Trump, on what he called Liberation Day, announced pretty much tariffs against pretty much every country around the globe of at least 10%, some as high as 50%. This is on top of tariffs that have already been implemented against China and Mexico and on all sorts of other things that I can't even keep track of anymore. Lisa, this is going to have a significant impact on the economy. I don't think that there's any question about that. It is going to drive up costs. It is going to lead to higher prices for consumers. A piece of data that I just saw today was that the average family is going to spend another $30,000 this year on higher prices related to the tariffs. It's going to increase inflation by 1 to 2 points, which is not insignificant. None of that is insignificant. And then to me, Lisa, the concern here is that this is coming at a time when the consumer isn't exactly flexing its spending muscles, at least when it comes to restaurants.
That's right. You said $3,000, right, for the average
$3,000 for the average.
Yeah.
Yep. That's a chunk of change.
That's a chunk of change. That's money. And people are hearing about this. And, you know, there's been this sort of on again, off again thing. I think people were thinking maybe even this morning they might wake up and say and hear that the president has changed his mind, as he has, you know, it seemed to a few times. But no, we have them now. They are in place and they are going to impact the economy, I think, very significantly. You know, there's talk of it even causing a recession. But I mean, I do think restaurant companies are going to be paying very close attention to this because it really does make consumers feel like they need to pull back a bit. I mean, there's just no question. I think people are going to start thinking about spending less money, sticking more to their budgets. And even though, you know, restaurants are going to be seeing higher costs that they're going to have to deal with one way or the other, whether it's through inflation, through food costs or building costs, all of those things are going to be impacted. They really can't pass that on to the consumer right now, or at least a lot of chains don't feel that they can.
No, they don't. Restaurants don't have any pricing power. Let me correct myself, by the way. It's not $3,000. It's $3,800 in for the average family. And obviously that varies based on income. So those at the bottom of the income spectrum, that's $1,700. It's still not an insignificant amount of money. But yeah, I mean, to your point, you know, the industry just doesn't have any pricing power right now. It's particularly true for fast food chains. I mean, you know, and it'll lead into the next discussion, but consumers are not eating out at fast food chains as much. And they're doing it because they're really upset over high prices. The thing is like, I pay a lot of attention to this stuff. And last year, that's all I saw last year on social media. The only thing that people was talking about, like invariably, anytime I would tweet or send out any sort of social post at all, a lot of times, you know, consumers would respond with something about how expensive it was. I appeared on the Today Show multiple times talking about fast food prices. It was something that they were just really overly concerned with for good reason. I mean, like, look, I mean, consumers pay high prices. It eats into their spending power and it frustrates them. It's why it's wwhy the election was the result that it was, because people were pissed off about high prices. And, and so to me, like it's, now we're adding on top of that, we're going to add, more cost pressures. And, it's really going to, play a significant role to me, I think, in sort of the state of the economy. And by the way, I will add one more thing here, because this is really flying under the radar. The biggest, to be honest, the biggest piece of news, and I'll deal with this more in depth on my podcast next week. And it's about whole business security. It's not about hope. It's about, the financing market. The biggest concern that I have right now is with the state of the lending market and Chuck E. Cheese. You've heard of them?
I have, yes.
Yeah. So they went to the bond markets with a $660 million bond offering. This was before these new tariffs came in. They could not get, and Chuck E. Cheese, by the way, is generally doing okay. They did file for bankruptcy in 2020, but they've been doing some of the things that you want to see companies do. They spent $350 million to invest in that company. They added a bunch of really cool stuff. Really brought that concept into the modern age. Now they do have some problems with their sector. Entertainment is just like falling off a cliff. It's actually been kind of shocking. They couldn't get people interested in their bond offering, despite the fact that, there's nothing outwardly screaming that this is a massive problem. And the reason given for this was that investors who buy up these bonds, they're the ones that will buy these bonds that enable these companies to do this. They are concerned about tariffs and the impact on the restaurant industry. And that to me is, and maybe it's just a one-off thing, and who knows, but like the concept, the idea, and this is where tariffs play a role, is like tariffs are really getting people concerned about the state of the economy. Consumer confidence fell like a brick. Right now the stock market is falling like a brick.
Yeah. I don't even want to look.
Yeah. And it's playing a role, and that's going to cause problems in the financing markets up and down.
Yeah.
From companies like, you name whatever company, like Inspire Brands, not going to go public this year, like we probably expected heading into this year. I think that's probably, I don't have any intelligence on it. That's probably off the table.
Right. And Panera, the Panera plan's also been off the table for a while, but this isn't going to help.
Well, I mean, Panera's plan's off the table for Panera reasons, frankly. Sure.
Well, but the market also, I'm sure, had an impact. But anyway, to carry on with your point, which.
Yeah. I mean, but my whole point is this is not good. So that's my general thought. That's my general point there, Lisa. This is not good.
Yeah, I totally agree. And interest rates as well. There was, the hope that interest rates would be coming down, and they did start to come down. And now it doesn't seem like that's going to be happening either. So, I mean, this just makes it harder for franchise expansion and, all of it. All of it's very challenging. And remember that restaurants are still dealing with elevated labor costs. That's just going to be the way of things going forward. And even though tariffs might not impact that, it's just another burden that restaurant operators have to figure out how to manage. They've got these higher costs, higher operating costs across the board. This is going to create, even heavier load for them.
Yeah. Yeah. I mean, just look at the last 5 years, one thing after the other, you had the pandemic, you had sort of a false recovery, but then you had, soaring inflation that we hadn't seen in 40 years. You had, and then you had consumers' reaction to this. And now we have this, really, it's like pretty much almost something every single year for the past 5 years. And it's really testing out. It's got to be challenging for operators. And, as I said, wasn't it really a good, for the restaurant industry, it's been pretty problematic because of weak profit margins and weak traffic and all of these other things. And now we're adding more stuff onto it. So really tough. And that leads me into this next topic. Because it's not just your McDonald's of the world, Lisa, that's been having some challenges with consumer frustration over high prices. Chick-fil-A last year grew sales 5.4%. Now, generally, you would think that's pretty decent, wouldn't you?
Yes, but knowing Chick-fil-A's trends, That is a bit of a,
No, it's a slowdown. It's a significant slowdown. And it's a slowdown based on sales per existing unit. So their sales at, your standalone Chick-fil-A actually went down slightly last year. Chick-fil-A for 2006 and 2006 and 2023, they had averaged a 14% sales increase on an annual basis because they were building about units at about 5% clip a year. And then they would increase average unit volumes by about 10%.
Yeah.
And that was they were able to thrive, and they came out of nowhere. I mean, this is a mall concept, Lisa. That's what they used to. They used to be a mall concept. This is basically like, I don't know. This is like Sbarro becoming the world's, the country's third largest restaurant chain. This is basically like somewhere the equivalent of that.
Well, there probably are people who would argue that kind of number is unsustainable. You can't have a 14% growth.
I would say that's true. I mean, all companies eventually have down years.
Yeah.
But to me, I mean, eventually something was going to have to happen. I don't think there's any question. And I completely agree with that. Like, at some point, you're going to go into markets that you can't really support $9 million standalone average unit volumes, which is what your typical Chick-fil-A with a drive-through does. This is insane. That's like Cheesecake Factory. They're like close. And then if you adjust for how busy you are and all that, other Chick-fil-A is insane.
Yeah, but this slowdown, I mean, if Chick-fil-A is sort of on the edge of fast food, I mean, it's fast casual-ish in my mind, but you see it as more fast food. It is being impacted by the economy. I think that's what would explain, this kind of slowdown in growth. And yet, though, according to our Technomic numbers, which are just out, Wingstop was up, 37%?
Mm-hmm.
So, similar in category. It's about chicken. Yeah. So they don't seem to be.
Yeah, well, you have an entire reconfiguration of the entire chicken market, actually. And that's a really good point. Like, look, I mean, it's just 1 year for Chick-fil-A. They're an amazing company. They'll pick things back up. All companies are allowed to have periods of weakness. My thinking, on Chick-fil-A is I just think this is a real issue with value. I think with Chick-fil-A in particular, they have generally raised prices relatively aggressively, particularly compared with a lot of other fast food restaurants. And I think consumers notice that. And if you see their value scores, their value scores took a hit last year. And so to me, this wasn't terribly surprising. Given what I'd heard and what we talked about earlier, consumers really did not like the prices at fast food restaurants, and Chick-fil-A is a fast food restaurant. But back to what you were talking about this, reconfiguration of the chicken market. So it's not just Wingstop. Raising Cane's is now a top 20 restaurant chain.
Yeah.
$6.5 million unit volumes, which I can't even fathom that. Like that's $6.5 million. They sell chicken tenders, chicken fingers, whatever you want to call them.
I think now it's 6.9. Yeah, but yeah.
No, it's ridiculous. It's 6.5, 6.9. It's stupid numbers. And the thing is, like, so Raising Cane's surpassed KFC. So they leapfrog KFC. And Wingstop is going to leapfrog KFC probably next year, which is so that means if you look at it, the KFC, historically, the giant in the chicken business is going to be the number 5 chicken chain in the United States. Probably 6 if you calculate McDonald's chicken sales.
Yeah, that's amazing.
Yeah. So it's pretty incredible what's happening in the chicken market.
And value is part of it, but it's also just, relevance. I think, Chick-fil-A has had terrific marketing along the way. They, yes, it was a mall brand, but they've also really transformed themselves into something that really has, captured the Gen Z. They love their Chick-fil-A. Same with Wingstop. And that's what the challenge is for KFC, is to try to figure out a way to get it back.
Mm-hmm. Yeah. And Raising Cane's, the kids love Raising Cane's. The sauce is really good. Yeah. I mean, look, I actually had KFC last night for dinner, Lisa. Yeah. It's good. I like KFC. I always have.
I have always liked KFC.
Sides not so good, but their chicken, their chicken sandwich is amazing. So to me, their problems are outside of what the menu is, and marketing is probably a problem. They haven't really been the same since Kevin Hochman left, and that sort of thing. So, yeah, I mean, it's just the industry is sort of the fast casual business. The next generation fast food is really sort of taken over the industry. We saw that in the numbers. That's a nice little preview for Top 500. But we need to talk about this next thing. Speaking of high volume restaurants,
yes,
Portillo's. What the hell?
Portillo. So they're going to start in select restaurants testing breakfast as a day part in Chicago. They haven't said what they're going to do on the menu. They showed just a little cryptic picture on Instagram it looked like an egg croissant sandwich. And so they'll let us know. They're going to be announcing this next week or the week after. And they're, maybe thinking about bringing in a new day part, which is probably a good idea for the brand, which, they haven't, their sales have been also sinking a little bit at Portillo's. They're growing outside the Chicago area. And even though people just love them in Texas and the other Sunbelt states that they're going into, their sales aren't really showing quite the volumes that they have in Chicago, which are extraordinary. And so I think they're just looking for another opportunity to bring in sales with a new day part and make better. They've been trying to cut the costs of their building. They're building smaller restaurants, better engineered to streamline operations. And they're even in Houston, they're testing a streamlined menu, which is, Portillo's menu is pretty big, as you probably know, because you're in Chicago more than me. And, so it's interesting that they're looking at a new day part as part of all of this. But we'll see what they do and what they say and what the hours will be. That's all yet to be revealed.
Now, their average unit volumes went down by about $400,000 per unit. It's still at 8.7 million, the highest in fast food. As compared to Chick-fil-A, which does 7.5 million. But I will point out on the Chick-fil-A versus Portillo's debate, your standalone Chick-fil-A does more volumes now than your standalone Portillo's.
Yeah. How about that? Yeah.
Yeah. Which is really incredible. Portillo's got a massive menu.
Yeah.
I got to admit, I am skeptical of Portillo's breakfast. Not everybody needs to do breakfast. And I think Taco Bell taught us that. And Taco Bell should have been able to do breakfast in theory. People had been accustomed to breakfast tacos and breakfast burritos, and they've got a marketing arm that is second to none in the restaurant industry. I think that's fair to say, with the maybe exception of McDonald's. But McDonald's could just flood the zone with billions of dollars in advertising. But I don't know. I'm skeptical. I mean, I guess I have to see the offering, but not everybody needs to do breakfast, Lisa.
Yeah, it depends on what they do. I mean, maybe they're going to use some of the products that they're known for. I mean, people could eat hot dogs for breakfast. There's certainly sausages and things like that.
Sure.
Yeah, I mean, it's going to be something egg based, which is, seems like kind of a bad time to be looking for eggs. But we'll see. We'll see what they do, and if it could be something smaller. They're pushing drive-throughs, so this is going to be something that would be convenient, drive-through kind of thing. They probably already have coffee on the menu, I would imagine, and they could make use of that cake. I'm telling you, for some sort of breakfast version of it would work for me.
Just serve a cake shake for breakfast. I'd have a cake.
Yeah, why not?
No, I can't afford the calories to eat it for dessert, especially after eating one of those sandwiches. But I mean, they could do something cool with the menu. I mean, Italian beef. I think Joe Guszkowski mentioned it on our team's channel. An Italian beef omelet. Sure. Well, you could probably put Italian beef. You could probably make an egg sandwich with Italian beef and egg. With Italian beef and eggs. That would be delicious. I would eat that all day.
Out here in LA, people eat burgers for breakfast. I mean, it's a very common thing.
You guys are weird. Come on, honestly, sure.
Kind of weird.
You guys are weird.
Put eggs on them, so it's breakfast.
Yeah, sure. All right. Yeah. Well, I mean, yeah. Well, I mean, but then again, as I said, I mean, the menu could be delicious. And I thought that, I'll go back to the Taco Bell example. Taco Bell, there are other reasons. Breakfast is tough to break into. It's a really hard thing to do. And, it took Wendy's 4 tries to actually make it work. It's kind of ridiculous. Taco Bell couldn't do it with massive marketing, and they couldn't do it. They were getting all kinds of attention for their breakfast, and they still have breakfast-ish, but then not everybody does breakfast, and because franchisees can bow out, the company isn't really marketing it. No, they want to go back to it, but it's really tough. Breakfast is really, really hard. It is hard. It is not for the faint of heart. And
there is the slight headwind, though, of return to work. I mean, if it continues, if more people are coming back into the office, they are going to be looking more for, breakfast out, I would think. So
yeah, but they did. I mean, not everybody, as I said, you are who you are in this business. Yeah, and it's not. It's really difficult. It's just a market, and again, like, just because it's difficult doesn't mean you shouldn't do it. But I tend to think what happens is, in these scenarios, and this goes for a lot of different things, if you're going to test something like breakfast at your restaurant, you really have to be sure there is a lot of potential, or that consumers are asking for it, or there's something that says this is just an obvious thing for you to do, because that means you're paying that less attention to things that can bring in your customers to your existing restaurants. And if you start selling breakfast at your existing restaurants, you are going to lose some business later in the day. That is inevitable. And so that's where I get concerned. It's like, it's not that they, I'd rather they invest the money into breakfast than a stupid sale lease, or a stupid share buyback, or throwing money at investors is a cheap way to boost the stock price. I mean, it's great. But like, to me, it's just, devote your money, whatever is, to marketing Portillo's, because you've got a great offering the rest of the day. And I'm just not sure it's fully necessary. But you know what? Maybe I'm wrong, and I've been wrong before. And that should do it for that week's discussion. Coming up next, we will have Joe Guszkowski talking about technology, and a preview of this coming Sunday story, and on the CEO of the industry's most surprising chains right now.
Are you looking for a new podcast that provides practical tips for running your restaurant business? Do you want to hear from the food service world's most influential decision makers? Then go subscribe to my podcast, Takeaway with Sam Okus, which features everyone from the CEOs of the biggest restaurant chains to the leaders of small but mighty emerging brands. At the end of each interview, I provide my takeaways from the discussion, giving you actionable insights that you can take with you on the go. Go subscribe to Takeaway with Sam Okus wherever you listen to podcasts.
Hey everyone, welcome to Tech Check, where I, Joe Guszkowski, talk really fast about one big topic in restaurant tech. This week, maybe restaurant delivery was never meant to be affordable. Restaurant delivery prices have been in the headlines again recently. That's thanks to DoorDash, which recently partnered with a company called Klarna to give customers the option to pay for their orders in installments. This got the whole internet joking about the idea of burrito loans, but it's worth remembering why someone might need a burrito loan in the first place. Despite many attempts to lower costs, restaurant delivery is still really expensive. Getting food from a restaurant to your home is a labor and tech-intensive process, and those costs get passed to the consumer in the form of fees. Those fees, plus price markups and tips, can easily more than double the regular price of the item. At the same time, it's not like anyone is really making money here. Even the delivery providers were unprofitable until very recently. There are efforts out there to try to bring down these costs, mainly by automating the restaurant, the delivery vehicles, or both, but you have to step back and wonder if the juice is really worth the squeeze. After all, there are a whole lot of other ways to get food that have served us just fine for decades, and delivery will always be an option for those willing to spend. But upending the entire restaurant business just to feed our demand for convenience may be a step too far.
We have been talking about Chili's an awful lot over the past few months, and I know that you recently sat down with Kevin Hochman and got some great insights. Tell me what you've got coming.
I am pretty certain, by the way, that this podcast represents a record-breaking number of times that Chili's has been mentioned in a single podcast in a single year of all time. I'm pretty safe to say that Chili's has never been mentioned this much on a podcast. It has on this podcast in particular, not to mention my own A Deeper Dive. So yes, Lisa, I spent a week with Kevin Hochman, who is our restaurant leader of the year. It was by the end of it, he's pretty much wondering, you're still here? That sort of thing. So And then I wrote a profile about him and the work that was done at Chili's last year, which, to remind you, their sales, I think, were up, total sales up 15%. Same store sales in the last quarter of 2024, 31.4%, which is ridiculous. And nobody, I think Greg Creed pretty much said it best. He wouldn't have believed you if you told him that Chili's would ever. He had no idea that Chili's would ever do that. He thought the sector was dead. By the way, this year he looks even better. Not only given the challenges at KFC, but you have so many casual dining bankruptcies: TGI Fridays, Hooters, Red Lobster, all these other ones. So you got basically casual dining struggling badly, and then here's Chili's doing 31%. So he's an interesting guy. He's, did some very interesting things. And I think the one thing to give you a little preview of, for the story, which you can find at restaurantbusinessonline.com now, it's actually published. So, which is when he first became the CEO of Brinker International, he gets up at the company's general managers conference in Dallas, and he held up the cover of Inc. magazine, a fake cover of Inc. magazine, saying Chili's had come back, and said this was in 3 years. 3 years. And essentially it was a fake cover of a magazine, basically saying Chili's is back, and telling them this is what's going to be written about us in 3 years. That we did it by improving the quality of food, improving service, and then customers are going to come back. And if anything, he was too conservative with that goal.
Absolutely.
Because, they've been featured on a number of different publications, and certainly ours. As I said, we've been mentioning them over and over and over again, and for good reason. They provide a lot of really good examples of what you should do as a restaurant company. It's really not, this isn't rocket surgery, Lisa. You improve, you make sure that the food you're serving is really good, and that you give people a good service. Chili's last year was a big beneficiary of social media buzz. Big. And what they did was they focused so much on service to ensure that once people got in the door, that they were ready for that. And that's essentially what happened. And so you go into Chili's and you're generally getting really good service. And that's the right way of doing things. It's a good lesson for the rest of the industry, Lisa.
Indeed. And a good cheese pull.
Yeah, and a good cheese pull. Awesome. Well, thank you very much. And that should do it for this week's episode of The Week in Restaurants, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at restaurantbusinessonline.com. And please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, the editor-in-chief of Restaurant Business. Thank you for listening.